Hey everyone, today we're going to do something a little bit different. I'm essentially going to teach you the basics of investing and how to get rich like a lazy gamer. And by lazy gamer, I just mean putting in the least amount of effort possible and getting the most amount of return. This is how a lot of people like to approach their games. They may want to know how to level up the fastest, how to get the trophies with the least amount of friction, that sort of thing. And that just so happens to be a fantastic approach to investing. Now, I know this is a bit off topic for me, but this is a super important skill that everyone should know, and almost nobody does. It's not taught in school. Most people don't just randomly learn it during their lives, but it's very important because it's the path to a better life. It's how most people that are rich got rich, and it's just something that really everyone should know. I've had a lot of success investing in my life, so I want to teach you the basics and essentially what I know, and hopefully that'll help you have success as well. And then you can have an awesome life and buy all the things that you want and support other people and do whatever you want and just feel secure. That's what I would want for all of you. So let's get started, and hopefully we can get there. So the first thing you absolutely have to know is compound interest. All this is your money makes money, and then that money that you made makes money, and then that money makes money, and so on and so forth. And it has a snowball effect over long periods of time, which is extremely beneficial. So you don't actually need to know the math behind how that works. You can come to a handy dandy compound interest calculator. This one's from NerdWallet, but any will do. Just search for one and use whatever. And you can come here and you can play with numbers and see what's possible and make a goal for yourself. So let's go ahead and make an example. Let's say you are 25 years old and you want to retire at 65 with $1 million. How would you do that? Well, in this case, it's $310 a month, which may not seem like enough, but it is thanks to the magic of compound interest. So we're going to put an initial deposit of $310. We've got 40 years of growth. Our estimated rate of return is 8%. That's a reliable return that we can get in the stock market, and we're going to explain why in a bit. Compound frequency is annually, and contribution amount is going to be $310 a month. And that gets us to just over $1 million after 40 years. This blue line right here, that's what we contributed. So in this case, when it's all said and done, we put in $149,110, and we generated the green line and ended up with $856,159.20. So that is a ridiculously awesome return. So much money that we generated over those 40 years. And now we've got that $1 million. But obviously this is someone that started really early, and they had time for that compound interest to do work. Because if we look at this, the first 20 years, not a whole lot of growth there. But that next 20, it takes off like a rocket. And if we continued, it's just going to continue to get crazier. Like if we went to 50 years, it goes to 2.2 million. So another 10 years and you more than doubled. But you probably don't want to retire at 75, so we're going to keep it at 65. Now, let's say you have less time. Well, then you're not going to get this sort of result. So let's say you're 40 and you have the same goal. You want to retire at 65, and you're going to put in the $310 a month. That's only going to get you to $283,000. So, like close to a fourth of what the 25-year-old got. If this person wanted to get to $1 million, they actually have to go all the way up to $1,100 a month. So if they do $1,100 a month, they can get to $1 million. But the equation's not as friendly. So you can see they actually put in $1/3 and generated 2/3, which is still fantastic. Don't get me wrong, but it's nowhere near as good as the other one. So this just demonstrates you want to get started as early as possible. Now, obviously, you don't have to get to $1 million. That's just a big number that I use because everyone considers $1 million a lot of money. But whatever's possible for you, you can come in here and see where you're likely to end up in terms of results. So like maybe you can do $100 a month and you're 25. So if you did 100, you end up with a third of a million, which is still a bunch. And also keep in mind, wherever you end up, that money is going to keep making money. So now, like, you're not working anymore. You're not presumably making any money. You're using this for the rest of your life, essentially. But it's going to keep making money as well. So it's not that you just have that money. You have a whole lot more money that's going to come in as you withdraw that money. And there's a bunch of strategies to that. But that's all more advanced stuff. We're just going over basics here. But just keep in mind that it keeps making money. All right, so now that you understand the basics of compound interest, let's talk about the stock market. And we're going to talk about the U.S. stock market because anyone can invest in the U.S. stock market as far as I know. And it's where I live, so this is what I know. And in the U.S. stock market, there's something called the S&P 500. What this is it's the 500 biggest stocks on the exchange. The 500 biggest companies, it's all of them represented as a number. And this has been an extremely consistent and good return over the entire history of its existence. So like 80-something years, this has been an amazing return. It actually returns a little over 10% on average. So we're using 8%. We're being slightly conservative. Some would say even that might be slightly aggressive, but regardless, we're using 8%, but historically this has been 10%. So just keep that in mind. And this is what we want. We want a consistent return where we can safely just park our money and have a very high likelihood that we end up not only making money, but making a lot of money. So this is exactly what we're looking for. But we can't buy this directly. This is just a number representation of all of those stocks. But what we can buy is called an ETF. An ETF is just a bundle of stocks, and there happens to be S&P 500 ETFs. So that's just all 500 of those stocks bundled together in a single stock that you can buy. And there's two that I'm aware of. There's VOO and SPY. I personally invest in VOO, which is what I'm showing on the screen. But it's essentially the same as SPY. The only difference that I'm aware of is that VOO has lower fees. So that's why I like it. But anyways, all the goal of this, not even the goal, what this stock does is it just mirrors the S&P 500. So whatever the S&P 500 is doing, it does that. S&P 500 goes up 1%, it goes up 1%. S&P 500 goes down 2%, it goes down 2%. It's going to do exactly what this does. And one thing I forgot to mention, the other thing that makes the S&P 500 so desirable for us is, one, we want to be lazy and we don't want to do too much. We just put the money in and make money. But also, this outperforms 90% of all people that are trying to beat it. So all investors, 90% of them are not beating this. Only 10% are doing it. And some are awesome, and you know, you can take the risk to find them if you want, but I would rather just take the easy route. And like I said, we're trying to be lazy here. We're lazy gamers. So this is a great way to be lazy and make money and outperform the vast majority of people. So if we look at VOO, it's obviously expensive. It's $541 to buy it. That's not even covering the monthly contribution that we did for the million example, because that was $310. But you could either wait until you can buy, like, you know, just accumulate the cash, and then when you have enough, you could buy. Or a lot of platforms will let you buy fractional shares, so you could buy like half or a fourth or whatever they allow. So that's just something to consider. Don't be too alarmed by the price. There's ways around that. But what I wanted to show on here especially is something called the yield. So price goes up, we make money, investment makes money. That's all good and pretty easy to understand. The yield's a little more opaque. All the yield is the dividend. That is a percentage of the amount you have invested that you're going to receive as just straight money every year. So the yield for VOO is currently 1.24%. It does fluctuate, but it's currently 1.24%. So what that means is if you had $100 invested in VOO, during the course of the year, they're going to give you $1.24. If you have $1 million, it's $12,400. You get the idea. Keep in mind the 10% number for the S&P's like average return is considering that you're reinvesting this dividend. So you're not taking that cash and like, going and buying stuff. You're just putting that money directly back in. That's where that 10% number comes from. So just keep that in mind. If you're going to take that dividend, you're not getting the 10%, at least historically. You're going to be much lower than that. But yeah, that's what the dividend is. Anytime you see yield on a stock, that's what that is. That's just money that you get as a percentage of what you have invested. And yeah, this is seriously like just it. It's not complicated. You just put your money in monthly, whatever your cadence is, and you just let it do its thing. You never look at it. You don't think about it. It's better not to think about it, because then you're not like tracking price and thinking about potentially selling, because that's not what you want. You want to just keep the money in there long term, let it do its thing, and you just consistently contribute. It's called dollar cost averaging. It's just a superior approach to putting in money than people that try to like time it. Like, for example, like obviously you want to buy the stock when it's low. Like if we look at this little period of time here, like it was very high and then it went really low. So you might be tempted like, oh, well, maybe I could sell there and I could buy here. But you're not going to be able to predict that. Like there's such a small fraction of people that have any sort of skill in trying to decipher what the stock market is going to do. It's not worth attempting. Your best bet is just consistently throw in the money. Doesn't matter what the price is. I throw in the money and I just live with the results. And I just know that over time, I'm in a safe investment that goes up. And that's all you really need to know. And yeah, that's as simple as it is. And that's what I've done. And it's worked out fantastic for me. And that's what people have done historically. And it works out fantastic for them. There's no guarantees in this. Anytime you invest money, you can lose money. You could not gain as much as you thought. Anything's possible, but this is a very safe investment that works out well for the it's worked out well historically for everyone who stays in long term. If you go short term, things can go bad. Like if we look at this chart, the years 1996 to 2011, there wasn't much happening there. Like this period was not good. But we're not looking at 10, 15-year periods. We're looking at longer, 20, 30, 40. And if we're in there, if we're in the S&P for that long, we're historically going to have good results and we're going to make money. And hopefully we're just in like a really good time period. You can't predict it. The last, you can see the last, what's it been? I guess the last 15 years have been absolutely amazing. So unfortunately, if you haven't been in the stock market, you've missed out on that. But we don't know what's going to happen. Maybe the next 15 years will be better. Maybe it'll be flat. We have no idea. Nobody really knows. But we know that putting in the money in a consistent basis and being invested in this long term has had fantastic results for pretty much everyone that's done it. So yeah, that's basically it. The only other thing to go over is how you buy stocks. There's lots of financial companies, institutions, I don't know what to call them. But anyways, lots of financial services that you can use to buy stocks. Fidelity is the one that I use, but there's tons. There's Robinhood. There's Robinhood twice for some reason. E-Trade. What else? Charles Schwab. Moomoo. Probably a billion others I don't know about. But anyways, let's just find one that you like. You can buy stocks with them. And just make sure it's a company that you like. Do your research. Obviously, don't just pick a random one. But yeah, it's not complicated. You just search. If you want to use this strategy, you just search VOO and you buy it when you can. Look at their fractional. Look at how they handle fractional shares, if they do fractional shares, if you're looking for that or not. That's all up to you. But yeah, that's basically it. This is how the vast majority of people get rich. They just have consistent investments that they park their money in, and then way down the future, they've got a huge pile of money to do with as they please. And I hope that you all end up with a giant pile of money at the end of your journey, because that's what I plan to do. And so far I'm on track, because I just do what I said. I always throw in the money, and I'm consistent, and I'm disciplined, and I'm sticking to the plan, and it's been working great. So yeah, that's it. Thank you all for watching, and hope you have a good one, and I hope this helps.